There's a three-digit number following you around right now. You can't see it. You didn't choose it. But it's quietly deciding whether you get that apartment, how much you pay for your car, and sometimes even whether you get hired for a job. That number is your credit score. And for something so powerful, almost nobody explains how it actually works. I spent years thinking my credit score was some mysterious judgment from the financial gods. Turns out, it's way more predictable than that. Once I understood the rules, I felt genuinely annoyed that nobody had laid this out for me sooner. So, let's fix that right now. Your credit score is basically a grade that tells lenders how risky it is to lend you money. That's it. It's not a measure of your worth as a person. It's not a judgment of your character. It's a prediction. Specifically, it predicts how likely you are to pay back what you borrow. The score ranges from 300 to 850. Most people land somewhere between 600 and 750. If you're above 700, you're in solid shape. Above 760, and you're getting the best deals available. Below 600, and things get expensive fast. Here's where it gets real. Let's say two people want to buy the same car, same model, same dealership, same price tag of $30,000. Person A has a credit score of 760, person B has a score of 620. Person A gets an interest rate of 5%. Person B gets offered 12%. Over a 5-year loan, person A pays about $4,000 in interest. Person B pays about $10,000 in interest. Same car, $6,000 more, just because of that three-digit number. And cars are just the beginning. When you apply for a mortgage, the difference between a good and bad credit score can mean tens of thousands of dollars over the life of your loan. We're talking the cost of a college education, just in extra interest payments. So, how does this number get calculated? Who's doing the math? There are three main companies tracking your credit history: Equifax, Experian, and TransUnion. Think of them as three different teachers grading the same homework. They each collect information about your borrowing behavior, and they each calculate their own score. Sometimes those scores are slightly different, which is annoying but normal. The most common scoring system is called FICO. It weighs 5 different factors, and here's where paying attention really pays off. The biggest chunk, about 35% of your score, comes from your payment history. This is straightforward. Do you pay your bills on time? That's it. Every time you make a payment by the due date, it helps. Every time you miss one, it hurts. A single payment that's 30 days late can drop your score by 50 to 100 points, and that mark stays on your record for 7 years. I know, 7 years feels dramatic. But here's the good news. The older that late payment gets, the less it affects your score. A late payment from 6 years ago barely registers compared to one from last month. The second biggest factor, around 30%, is something called credit utilization. This sounds technical, but it's actually pretty intuitive. It's the percentage of your available credit that you're currently using. Let's say you have a credit card with a limit of $10,000. If your balance is $1,000, you're using 10% of your available credit. That's great. If your balance is $8,000, you're using 80%. That's a red flag to lenders. Here's what threw me off for years. I thought paying off my full balance every month was enough. And it is, eventually. But your score gets calculated based on your statement balance, not your paid-off balance. So if you spend $4,000 on your card with a $5,000 limit, pay it all off on the due date, but your statement closed when the balance was still high, your utilization looks like 80% that month. The sweet spot? Keep your utilization below 30%. Below 10% is even better. Some people game this by paying down their balance before the statement closes. Slightly tedious, but effective. Factor number 3 is the length of your credit history, which counts for about 15%. Lenders want to see a long track record. This is why people always say don't close your oldest credit card, even if you don't use it much anymore. That account is anchoring your average credit age. If your oldest card is from 2012 and you close it, suddenly your credit history might only stretch back to 2019. That matters. Factor 4 is your credit mix, about 10% of your score. Lenders like seeing that you can handle different types of credit responsibly. A credit card is what's called revolving credit. You can borrow up to a limit, pay it back, borrow again. A car loan or mortgage is installment credit. a fixed amount you pay back on a schedule. Having both types tends to boost your score slightly, but don't go taking out a car loan just to diversify. This factor is minor compared to the first two. The last 10% is new credit inquiries. Every time you apply for credit, the lender checks your score. That check, called a hard inquiry, dings your score by a few points. 1 or 2 inquiries aren't a big deal, but if you apply for 5 credit cards in 1 month, it looks like you're desperate for credit, which makes lenders nervous. Here's a useful detail though. When you're shopping for a mortgage or car loan, multiple inquiries within a 14 to 45-day window usually count as just 1. The scoring system knows you're comparison shopping, not being reckless. Now, let's tackle some things that surprisingly don't affect your credit score at all. Your income? Not part of the equation. You could make $500,000 a year and have terrible credit if you don't pay your bills. You could make $40,000 and have excellent credit. Your checking and savings account balances? Also not included. The credit bureaus don't see your bank accounts. Getting denied for credit doesn't hurt your score. The application triggered a hard inquiry, which has a small impact, but the rejection itself is invisible to future lenders. What about checking your own credit score? That's called a soft inquiry, and it has 0 impact. Check it as often as you want. Seriously, you should be checking it regularly. Speaking of which, you're entitled to 1 free credit report from each bureau every year through a site called Annual Credit Report. That's the official one. Anything else asking for money is unnecessary. Now here's what trips people up. Building credit when you don't have any. This is the frustrating catch-22. You need credit to get credit. Lenders want to see a track record, but you can't build a track record without someone giving you a chance. A few ways around this. First, you can become an authorized user on someone else's credit card. A parent or partner with good credit can add you to their account. Their positive payment history starts appearing on your credit report. You don't even need to use the card. Second, secured credit cards. These work differently from regular cards. You put down a deposit, say $500, and that becomes your credit limit. It's not a prepaid card. It's an actual credit card, and your payments get reported to the credit bureaus. After 6 months to a year of responsible use, many issuers will graduate you to a regular unsecured card and refund your deposit. Third, credit builder loans. Some banks and credit unions offer small loans specifically designed to help you build credit. You borrow a few $100s, they hold the money in a savings account while you make monthly payments, and then you get the money at the end. It sounds like a weird game, but it works. Let's talk about what to do if your score needs repair. First, pull your credit reports and actually read them. Errors happen more than you'd think. Wrong addresses, accounts that aren't yours, late payments that were actually on time. If you find a mistake, dispute it directly with the credit bureau. They're required to investigate within 30 days. Next, focus on the big 2 factors, payment history and utilization. Set up autopay for at least the minimum payment on everything. I know autopay feels scary if your checking account balance fluctuates, but 1 late payment can undo months of progress. For utilization, you can either pay down your balances or request a credit limit increase. If you've been a good customer for 6 months or more, many issuers will bump up your limit just because you asked. Your balance stays the same, but your utilization percentage drops. Just don't use that new limit as an excuse to spend more. One more myth to bust: closing a credit card you've paid off doesn't help your score. It actually can hurt it in 2 ways. First, you lose that available credit, which increases your utilization. Second, if it's an older card, it can shorten your credit history. If the card has an annual fee you don't want to pay, call and ask to downgrade to a no-fee version. You keep the account age without the cost. So, what do you actually do with all this? Here's your action list. Check your credit score this week. Seriously, set a reminder. You can get it free from your credit card issuer, your bank, or through services like Credit Karma. Look at where you stand and which factors need work. If you're missing payments, fix that first. It's the biggest piece of the puzzle. If your utilization is high, make a plan to get it below 30%. If you're just starting out, look into a secured card or becoming an authorized user. Your credit score isn't some mysterious force controlling your life. It's a game with known rules. And once you know the rules, you can play it strategically. If this made something click for you, subscribing to Like Your 5 means you'll catch the next video where we break down another concept that affects your wallet more than it should.